Your 30s are basically life's way of saying, congratulations on surviving your 20s. Now here is everything at once. 1 minute, you're celebrating your first real salary. The next, you're staring at a mortgage application, wondering how anyone actually affords to be a functioning adult. Your bank account is getting pulled in what feels like 17 different directions. Kids need college funds. Houses need down payments. Retirement accounts are practically screaming for attention. And somehow, through all of this chaos, you're supposed to maintain your sanity and maybe even enjoy your life a little bit. Here is what nobody tells you about your 30s. And I really wish someone had told me this earlier. Everyone talks about your 20s being the time to figure things out, to make mistakes, to learn. But your 30s, that is when you realize you were supposed to have figured things out already. The financial decisions you make during this decade will either set you up for a genuinely comfortable future or leave you scrambling to catch up for the next 30 years. That is not me being dramatic. That is just math. I'm Nick, and I help people understand how to build wealth without losing their minds in the process. If you're tired of feeling like your money disappears as fast as you earn it, like you're running on a financial treadmill that never actually gets you anywhere, make sure to hit that subscribe button. And if this video helps you get your financial act together, a thumbs up really does help the channel. Now, before we dive into these milestones, let me be crystal clear about something important. I'm not here to make you feel bad about where you currently stand financially. Maybe you're already crushing some of these goals and feeling pretty good about yourself. Or maybe you're looking at your bank account balance, wondering if you should give up traditional employment and become a professional dog walker. Either way, these milestones aren't meant to be judgment calls on your life choices. They're not a scorecard where you need a perfect 10 out of 10. Think of them as a roadmap, guide to help you navigate what can honestly be a pretty overwhelming decade of your life. So why do your 30s matter so much financially? Here is what makes this decade different from every other decade of your life. Your 30s are typically your prime earning years. Your salary is probably higher than it has ever been. And if you play your cards right, it is going to keep climbing. At the same time, your financial responsibilities are multiplying like rabbits. You might be dealing with a mortgage for the first time. Maybe you're raising kids, which, as any parent will tell you, is basically like having a money-burning machine in your house that you happen to love more than anything. Your career is demanding more of your time and energy. And for many people in their 30s, this is also when aging parents start needing more support, both emotionally and financially. The decisions you make right now in this decade compound over time, not just your investments, but your habits, your systems, your entire financial infrastructure. Get it right in your 30s, and your 40s, 50s, and beyond become dramatically easier. Get it wrong, and you spend the next several decades playing catch-up. That is the reality, and that is why I want to walk you through these 10 money milestones that can genuinely transform your financial future. The first major money milestone you need to hit in your 30s is eliminating all consumer debt. And when I say eliminate, I mean getting to zero. Zilch, nada, nothing. The only exception to this rule is your mortgage, assuming you have one. Everything else needs to go. Credit cards, obviously. Student loans, yes, even those. Car payments, that random furniture loan you took out 3 years ago because the store offered 0% interest and you convinced yourself it was a good deal. All of it needs to disappear from your life. Now, I can already hear what some of you are thinking. Nick, that sounds completely impossible. My student loans alone could fund a small country's GDP. I get it. I really do. Consumer debt in America has reached absolutely insane levels, and it is not because everyone suddenly became irresponsible with money. The system is designed to keep you in debt. But here is why eliminating this debt matters so much, specifically during your 30s. Remember what I said about your 30s being your prime earning decade. Your salary is likely higher than it has ever been, and it is probably going to keep climbing. The absolute last thing you want is consumer debt, acting like financial quicksand, dragging down every single dollar you earn before you even have a chance to build wealth with it. Let me put this in terms that might hit a little harder. Say you're paying $400 a month in credit card minimum payments, and you got another $600 going toward a car loan. That is $1,000 every single month that is walking out of your life and into someone else's pocket. That is money that could be building your wealth, but instead, it is building wealth for credit card companies and auto lenders. Over a year, that adds up to $12,000. Over a decade, that is $120,000. And here is the part that really stings. I'm not even accounting for what that money could have grown into if you'd invested it instead. With average market returns, that $120,000 could easily become $200,000 or more over 10 years. That is the true cost of carrying consumer debt through your 30s. Your 30s are also when life starts getting really complicated, really fast. You're dealing with increased responsibilities at work. You're trying to manage a household. Maybe you're raising kids, which is basically a full-time job on top of your actual full-time job. And for many people, this is when aging parents start needing more support. Trust me on this one. Having consumer debt hanging over your head during all of this is like trying to juggle flaming torches while riding a unicycle on a tightrope. Is it theoretically possible? Maybe. Is it advisable? Definitely not. I learned this lesson personally when my dad started needing more help around the house. He is one of those stubborn guys who wants to fix everything himself, which usually means I end up either doing it myself or paying someone else to do it properly. Just last week, we had a clogged sink situation where he was absolutely determined to tackle it with nothing but willpower and a plunger. Spoiler alert, it didn't work. If I'd been drowning in debt payments every month, I wouldn't have had the flexibility to just call a plumber and solve the problem. Instead, we'd probably still be dealing with a backed-up sink and a very frustrated father. Financial flexibility isn't just about big life decisions. It is about being able to handle the small emergencies that life throws at you without adding more stress to an already stressful situation. The second milestone you need to hit is achieving an excellent credit score. And I don't mean good. I don't mean pretty good. I mean excellent. We're talking 800 or higher. Now, I can already hear some of you saying that credit scores don't matter if you're not planning to borrow money. And in a perfect world where you could pay cash for everything, that would be true. But here is the reality check for those of us living in the actual world. Unless you're planning to pay cash for your house, and very few people can do that, your credit score is going to determine how much that mortgage costs you, not just whether you qualify, but how much you actually pay over the life of the loan. Let me put this in perspective with some actual numbers, because I think this is one of those things where the math really opens your eyes. Let's say you are buying a $400,000 house, which unfortunately isn't exactly mansion territory in most markets these days. It is a decent family home in a decent neighborhood with an excellent credit score of 800 or above. You might qualify for a 5% interest rate on a 30-year mortgage. Over the life of that loan, you pay roughly $511,000 in interest. That is in addition to the $400,000 principal. So your $400,000 house actually cost you over $900,000 by the time you're done paying for it. Not great, but that is the reality of how mortgages work. Now, here is where it gets interesting. If your credit score is just slightly worse, not terrible, just not excellent, maybe you are at 720 instead of 800, you might be looking at 7% instead of 6.5%. That 0.5% difference seems tiny, right? It seems like it shouldn't matter that much, but that seemingly small difference means you pay about $558,000 in interest over the life of the loan. That is almost $50,000 more for the exact same house, in the exact same neighborhood, with the exact same mortgage terms. $50,000 gone just because your credit score wasn't quite as good as it could have been. And here is where it gets really painful. According to LendingTree, just one late payment that is more than 30 days overdue can drop your credit score by as much as 180 points, and that negative mark stays on your credit report for up to 7 years. Imagine going from a 780 credit score to 600 because you forgot to pay your credit card bill 1 month, maybe You were traveling. Maybe you were dealing with a family emergency. Maybe you just genuinely forgot. One mistake, and that could literally cost you tens of thousands of dollars in additional mortgage interest over the next 30 years. The good news is that maintaining an excellent credit score isn't rocket science. It doesn't require a finance degree or some secret knowledge that only wealthy people have access to. Pay your bills on time every single time. Set up autopay for everything if you have to. Keep your credit utilization below 30% and ideally below 10%. Credit utilization is just a fancy way of saying how much of your available credit you're actually using. If you have a $10,000 credit limit, try to keep your balance below $3,000 and ideally below $1,000. Don't open new credit accounts unless you absolutely need them, because every new application temporarily dings your score, and whatever you do, don't close old credit cards unless they have annual fees you genuinely can't justify. Your credit history length matters, and closing old accounts can actually hurt your score, even if you never use those cards anymore. The third milestone is putting together a comprehensive financial plan for the next 30 years. I know, planning 30 years ahead sounds about as appealing as getting a root canal. It sounds overwhelming and maybe even pointless when you can barely plan what you're having for dinner next Tuesday. But hear me out, because this is actually more important than most people realize. Your 30s are when you start dealing with multiple financial priorities simultaneously, and this is new for most people. In your 20s, maybe you had one or two financial goals: pay off student loans, build an emergency fund, simple stuff. But in your 30s, suddenly you are trying to save for retirement while also saving for a house down payment, while also potentially saving for kids' college, while also trying to maintain an emergency fund, while also trying to actually enjoy your life occasionally. Without a plan, you're basically playing financial whack-a-mole, putting out whatever fire seems most urgent at the moment without any real strategy. I like to use the acronym BRET to think about comprehensive financial planning. The B is for budgeting and saving. You need to know exactly how much money you need to save and spend to hit your long-term goals. Not a vague sense of, I should save more, but actual numbers. How much do you need to retire comfortably? How much do you need for a house down payment? Work backward from those goals to figure out what you need to save each month. The R is for retirement planning, and this isn't just about contributing to your 401k automatically without ever looking at it. It is about actually understanding whether you're on track and what adjustments you might need to make. Are you contributing enough? Are you invested in the right things for your age and risk tolerance? Will you actually have enough when you need it? The E is for estate planning, which I know sounds morbid and like something only old people need to worry about. But if you have kids or significant assets or anyone who depends on you financially, estate planning isn't optional anymore. We'll talk more about this later in the video. The first T is for tax planning. This means making sure you're using every legal strategy available to keep more of your money. Are you maximizing your tax-advantaged accounts? Are you taking all the deductions you're entitled to? Tax planning isn't about cheating the system. It is about not paying more than you legally owe. The second T is for tracking your progress. A plan is useless if you create it once and then never look at it again. You need systems to regularly check whether you're on track and make adjustments when life inevitably changes. This might be the point where hiring a financial planner starts to make sense, especially if you're dealing with multiple income sources, significant assets, or complex family situations. A good financial planner can help you see the big picture and make sure all the pieces of your financial puzzle actually fit together. Think of it like having a personal trainer for your money. Sure, you could figure out a workout routine yourself, but sometimes having an expert guide makes the whole process more effective. The fourth milestone is building what I call a bulletproof emergency fund. In your 20s, the standard advice was 3 to 6 months of expenses, basically enough to cover you if you lost your job and needed time to find a new one. In your 30s, I want you to think bigger. We're talking 6 to 12 months of living expenses, maybe even more if your income is variable or you're self-employed. Why? The increase. Because your 30s come with way more potential emergencies, and those emergencies tend to be more expensive. Your house decides the water heater needs replacing at the absolute worst possible moment, and suddenly you are looking at a $2,000 expense you didn't plan for. Your kid needs emergency dental work that insurance doesn't fully cover. Your car breaks down, and of course, it is something expensive and complicated, not just a simple fix. Your aging parents need help with unexpected medical bills, or maybe, and this is actually the good kind of emergency, an incredible investment opportunity comes along that requires quick action. Maybe your dream house hits the market unexpectedly, or a business opportunity presents itself that won't wait. Having cash available means you can actually take advantage of opportunities, not just survive crises. Having a well-stocked emergency fund isn't just about financial security in the traditional sense. It is about having options. When you know you can handle whatever life throws at you, everything changes. You can take calculated risks at work that might pay off big because you're not terrified of losing your job. You can negotiate from a position of strength when asking for a raise because you're not desperate. You can help family members when they need it without destroying your own financial situation. You can sleep better at night knowing that a surprise expense won't derail your entire plan. The key is keeping this money somewhere. It can earn decent interest, but still be accessible. High-yield savings accounts are perfect for this. As of right now, you can find accounts paying 4 to 5% interest, which means your emergency fund is actually growing while it waits. You're not trying to get rich off your fund. The goal isn't maximum returns. You're trying to preserve your wealth and maintain flexibility. This money needs to be there when you need it, not locked up in investments that might be down the exact moment you have an emergency. The fifth milestone is having 3 times your annual salary saved for retirement by age 40. This is a concrete benchmark that gives you something specific to aim for. According to recent data, the average income for a 40-year-old in the United States is around $62,000, which means by this standard, you should have roughly $186,000 saved for retirement by the time you hit the big 4-0. Now, before you panic about whether you're on track, let me put this in perspective and show you why this number matters so much. If you start with $186,000 at age 40 and continue contributing consistently, say around 15% of your income each year, retirement calculators suggest you could have over $2 million by the time you are 67. That is the power of compound interest working in your favor. Your money earns returns, and then those returns earn returns, and it snowballs over time. But this snowball effect only works if you give it enough time to build momentum. Here is what is really important to understand about this milestone. Having a substantial retirement balance by 40 isn't just about the money itself. It is about giving compound interest decades to work for you. Every year you delay seriously saving for retirement is a year of potential growth you're giving up forever. You can't get that time back. If you wait until 50 to start saving seriously, you've lost 10 years of compounding, and no amount of aggressive saving in your 50s can fully make up for that lost time. If you're behind on this goal, and many people are, don't despair, but do get serious about catching up. You still have 25 to 30 years until retirement, which is plenty of time for compound interest to work its magic. But the math gets harder. Every year you wait, the gap between where you are and where you need to be gets wider and wider. If there is one retirement milestone to focus on during your 30s, it is this one. Consider increasing your contributions every chance you get. Every time you get a raise, bump up your retirement percentage. Before you get used to the extra money, every time you switch jobs, negotiate your 401k contribution as part of the package. Every time you get a bonus, consider directing at least part of it toward retirement. The difference between saving 15% of your income versus 10% might seem small now, but over 25 years, it is genuinely the difference between retiring comfortably and having to work until you are 75. The sixth milestone is something I call lifestyle inflation immunity. And honestly, this one separates the people who actually build wealth from the people who just look wealthy on Instagram. Your 30s are prime time for what economists call lifestyle creep. You know exactly what I'm talking about. Even if you've never heard the term before, you get a raise, and suddenly you deserve a nicer apartment. Your bonus comes through. So obviously, you need a fancier car. Your income goes up by $20,000, and somehow your expenses magically rise to meet it, leaving you with the exact same amount left over as when you were making $30,000 less. It is like your spending has a GPS that is constantly recalculating to match your income. I have friends in San Francisco making well over six figures who are somehow always broke. They re-driving $70,000 cars that they lease because they can't actually afford to buy them. They're living in apartments that cost more per month than most people's annual salaries. They're eating out every single night because apparently cooking is beneath them. And then they complain constantly about not being able to save money as if it is some great mystery. It is like watching someone pour water into a bucket with holes in the bottom and then wonder why it never fills up. Water isn't the problem. The holes are the problem. The secret weapon against lifestyle inflation isn't deprivation. I'm not telling you to live like a monk and never enjoy your money. The secret is automation and awareness. Every single time your income increases, automatically direct at least half of that increase toward savings and investments before your brain has time to dream up new ways to spend it. This is crucial. You have to move the money before you see it, before you get used to it, before you start thinking of it as money you can spend. Got a $5,000 raise? Great. Immediately increase your retirement contributions by $2,500 annually. Your future self will thank you, and your current self won't even miss money you never had the chance to spend. You can't miss what you never had. This simple strategy is how regular people on regular salaries end up with million-dollar retirement accounts, while high earners end up broke and stressed. The seventh milestone might sound morbid, but it is actually one of the most loving things you can do for your family. You need to get your estate planning sorted out. I know what you're thinking. You're way too young to worry about wills and trusts and all that death stuff. But here is the reframe. If you have kids, a mortgage, or any significant assets, this isn't about planning for death. It is about planning for life's unexpected curveballs. What happens if you're in a serious accident and can't make decisions for yourself? Who takes care of your kids? If something happens to both you and your spouse at the same time, what happens to your house, your retirement accounts, your life insurance proceeds? Without proper documentation, these incredibly important decisions get made by courts and bureaucrats instead of by you. Strangers will decide what happens to your children and your money. That is not a worst case scenario fantasy. That is what actually happens when people don't have basic estate documents. The good news is that basic estate planning isn't nearly as complicated or expensive as most people think. You can get started with simple online tools for basic wills and powers of attorney. If you have a complicated financial situation or family dynamics that would make a soap opera jealous, you'll want to work with an actual attorney. But for most people in their 30s, having something in place is infinitely better than having nothing. The eighth milestone is investing in your health. And before you roll your eyes thinking this video turned into a fitness channel, hear me out on the financial angle. Your health is genuinely your greatest financial asset, and your 30s are when you either build that asset or start watching it depreciate rapidly. Think about it mathematically. The average American spends over $300,000 on healthcare during their lifetime. If you can reduce that by even 20% through preventive care, better nutrition, regular exercise, and avoiding obviously destructive habits like smoking, you've just saved yourself $60,000, and that is not even counting the income you don't lose due to sick days, the career opportunities you don't miss because you feel terrible, or the quality of life improvements that come from actually feeling good in your own body. Your 30s are also when your metabolism decides to take an extended vacation. I used to eat pizza for every meal without consequences. Now, I look at a donut and gain 5 pounds. Developing healthy habits now. while you still have some metabolic flexibility, is dramatically easier than trying to reverse decades of damage in your 50s. The ninth milestone is starting to think seriously about your kids' education, assuming you have or plan to have children. College costs have increased at roughly twice the rate of inflation for the past 30 years. The average four-year degree at a public university now costs over $40,000 annually when you include room, board, and expenses. Private schools run closer to $70,000 per year. A 529 education savings plan is specifically designed for this situation. The money grows tax-free. Withdrawals for education expenses are tax-free, and many states offer additional tax deductions for contributions. Even saving $100 a month, starting when your child is born, gives that money 18 years to grow and compound. The 10th and final milestone is developing what I call financial confidence. This isn't about having a specific dollar amount. It is about understanding your situation well enough to make informed decisions without constant anxiety. It means not lying awake at 3 a.m. wondering if you'll ever be able to retire. Financial confidence comes from having systems in place and understanding how all the pieces fit together. Your emergency fund, retirement savings, insurance coverage, estate documents. These elements should work together as a cohesive strategy, not exist as random, disconnected pieces. So here is your action plan. Pick one or two of these milestones that resonate most with your current situation and start there today. Maybe it is finally tackling that credit card debt. Maybe it is opening that high-yield savings account you've been procrastinating on. Maybe it is scheduling a meeting with a financial planner. Small, consistent actions compound over time, just like your investments do. Your 30s don't have to be a financial disaster movie. These milestones are your roadmap to actually enjoying your 40s, 50s, and beyond without constantly worrying about money. The beautiful thing about being in your 30s is that you still have time to course correct. If you found this helpful, hit subscribe for more practical money strategies and drop a comment telling me which milestone you're focusing on first. I read every single one.